Welcome everybody to this fortnight's Q&A, talking about property. Australia's got a great love affair with property, and so welcome Andrew.
Welcome Mike.
So it started the new financial year, and we thought we'd allow the dust to settle a little bit in the property side of things, although the dust, I think, be fair to say, is still settling, which is fair call. But as I said, Australia's got a great love affair with property. Both, it's a bit of an Australian tradition to have own your own home, and then climb different ladders in having a better home than Jones's next door and things like that. And even through this COVID period, you look at the strength of Bunnings and how much business they've had, even though the actual property market's been subdued. People are still investing in their property and love doing things around the house, the shack, and their investment properties. So I'll get out of the way. I'll just share the screen, and I'll hand it over to Andrew, but we'll just do a bit of a tag team as we go through our presentation today.
Thanks, Mike. What I wanted to really talk about today is that we're going through fairly unusual times, fairly inconclusive on where property markets are at. We've got a few stimuluses coming out from the government, but there's been a lot of inquiries, especially prompted by the new stimulus package by the government. So first base, I just wanted to go through the love affair of property as such, and what most people want to have, and from my view, property serves a double-edged sword. It provides a home for us. It also can be as an investment, and then we have a few people, including yourself, Michael, who have a few investment properties as well as your own home. So as an asset class, Australia does have a love affair with it. And it's a good idea from a whole, I suppose, from a personal portfolio position, that it might make sense for individuals and couples to have their own exposure in that. But I thought I might just go through some stats today. I've been prodding around with the ABS stats.
Good stats are always handy.
Because of last time we did this couple of slides, and the good talking points. So the slide I brought up just runs through. It's taken actually from the statistics from 2017-18, and Australia had around about 9 million households in that year. So a lot of people own homes in Australia. 32% have rented their home, including 3% of all households who live in public housing. So there's a large
third of renters.
Yeah, third of rents. Yeah. And then there's 30% of their home is owned outright, which is interesting. So third, and then while the other portion is around about 30%, 37% with people who actually have a mortgage. So
I would have guessed that would have been higher, but that's interesting. Yeah.
I thought that was right. 30% own outright. Well, I'd like to be that person at some point.
Yeah, I suppose we're coming out of that era where you just accept that you've got a mortgage on your home. So and probably going towards, some of us paying down that mortgage. So
but that's right. Around 20% of all households own a property other than the one that they live in, which is interesting as well. I thought that was quite a large percentage.
So 1 in 5 people have an investment property, is that what you're saying?
Yeah.
Right.
But that figure includes people with holiday homes.
Oh, okay.
And,
shack.
But it's mostly for investment properties and so forth. And Australia has around a $1.86 million landlords, which was, I thought was quite a large number as well.
It is quite a large number, actually. Yeah, so it's not concentrated. And we're talking about residential homes, I suppose, just to clarify.
Yeah.
Just talking about the homes that people live in or rent in, not nothing to do with commercial activities or shopping centres.
That's right. Yeah. So that's a lot of people, and that's a lot of households from that perspective. So the other stats I was able to grab from the ABS was most of these residential investors own relatively small holdings, with 73% of them own a single investment property, while only 5% of these investors owned 4 or more properties. So predominantly people own the one investment property from that perspective.
I'll just check. Stephen's just joined. Do you hear us, Stephen? No. Might have a sound problem here. Might just stop the recording for a minute and see if we can get our sound, which is a shame after such a good start. Where is that? Pause share. Recording and share. Right.
So sorry about that slight delay there. We thought for a moment we were talking and no one could hear what we were saying.
That's all right.
Is it just the two of us?
Yeah, we're just recording it as well. That was all.
Oh, okay, cool.
That's all right, Steve.
So Australia has a relatively few large-scale property investors, and they're mostly made up of mums and dads investors, which makes up that large 73%.
Yeah.
So that's where I might park the statistics. Where I'm thinking is the impact of the COVID-19 and the last 3 months. The impact, I suppose our views probably changed slightly since the stimulus package has been announced. A month ago, my general view was we're heading towards a recession. That generally has an impact on property prices, and it was probably a bit more of a dour view. Did you have a different view, Mike?
I'll just have another stat just to share with you. This is from the Barefoot Investor Guide. So I listened to one of his podcasts a couple of weeks ago, and he had a guy called Lewis Christopher, who's a property guy that he consults with. So these are sort of macro stats and sort of validate some of the change. So he was predicting a real housing collapse. Well, not predicting. The numbers are showing that this was imminent, and mainly through the downturn in net migration. So essentially, predominantly in Melbourne and Sydney, there's 240,000 net migrants to Australia each year into those two cities, and they fuel a lot of new home developments. When you go to Melbourne, and it's whole new suburbs. I mean, there's a broadacre subdivisions, hundreds of thousands of lots being developed. So nationally, in rough terms, about 170,000 homes are built per annum, but the forecast was about an 80,000 shortfall. Like there's only going to be about 90,000 that wanted new homes, largely fueled from the lack of migration that the forecast for next year or two. The other factor at play through COVID has been the Airbnb. It's been a real rise and pulling properties out of the rental pool, and so their forecast is about 120,000. There's 120,000 Airbnb properties in Australia, and about a third or quarter of those they estimate will come out of their Airbnb and come back to the rental market. So you've got less demand, but also increased supply, and that 30,000 houses are coming back into the rental pool. So sort of a renter's market. Subsequent to that, and it was interesting that he made the comment at the time, he said, never underestimate the power of the government to make changes in the property market. And he quoted at the time the New South Wales government that had put $500 million into a pool to purchase housing for public housing, basically. And then since then, we've now had the federal government come out with their 25,000 home maker stimulus package, which is for first home buyers, and 25 grand towards their first home, and new builds. And most state governments, so the Tassie government, have matched that with 20 grand. And based on TV advertising, you're seeing a lot of property developers that are also putting in a discount as well, whether that's just marketing pipe, whatever. So they're doing that. So that's really, I suppose, the theory behind that sort of stimulus is to bring forward demand. So if I'm a young family, I might say, I might build my home or buy a home in 2 years' time. So it brings forward that decision making, because you've got effectively Tassie 45 grand protection on the table as an incentive from the government. So it brings that forward, but it also probably, from a government stimulus perspective, stimulates the construction or keeps the builders going, because you're making, or you're playing with the market to some extent. So if I'm a young couple, I'm sort of saying, well, for 45 grand, I get a brand new home, whereas if I go and buy an existing home, I don't get the 45 grand. Although, as I understand it, the Tassie government, you still get 20 grand from existing home, not the 25 from the federal, just the way I understand the incentives. So it sort of stopped this cliff that some of the forecasters and building industries were talking about. So that's at the macro level. What do I see locally? A lot of builders are saying they were busy anyway, but we're probably picking up the loss of potential demand probably in 12 months' time. Most builders sort of had an order book of 6 months or more in their sort of clientele. And in Tassie too, we don't have the broad acre stuff like, we'll have Magana and some of the blocks they're talking about carving up in Prospect and stuff like that, but it's not the Melbourne, Sydney, where you've got whole suburbs basically being created. So I don't think we're going to have the mass sort of demand or the mass cliff that was forecast nationally in some of these stats here. So if we strip it back again, we're still talking about pricing, and economic theory still holds true in my view, which is price is set when there's a willing buyer and willing seller. It's basic of economics, supply and demand. So if there's more supply coming through, which is what they forecast, then prices will fall. I always have a caveat with property. Two caveats. One is the government can pull levers, which is demonstrated with these stimulus packages. And secondly, and your stats show that 30% of people own it without a mortgage, 37% own it with a mortgage. So if I don't have a mortgage, I'm not going to sell, because I'm not going to sell it when the market's low. So you've got a third of the market really immune to any property price fluctuations and having to get out of it. And then you've got a percentage of that other 37% with a mortgage, whatever figure you want to pluck out of the air, then you don't have to sell, you just ride out the storm. Unless you both lost your job, or you paid too much for the house and you want to downsize, then you might have to crystallise a loss. But if you don't have to, then you just ride it out and wait for the natural rise that'll happen. And assuming we go back to normal migration patterns in a couple of years' time, then we'll have that underpinning national fuel still driving the market without stimulus. So I don't have as much of a doomsayer type of approach for property because of those two caveats I mentioned at the end.
So the way I see it is Australia, the rest of Australia versus Tassie. Tassie in itself is its own market. It has its own, I suppose, variances to the rest of Australia. My view is that there's only a certain time frame for this. For young people who are interested in getting plans and homes built. There's only a certain amount of builders in the state. So I think it's restrictive in that regard. And so how do you see that will play out in Tassie in terms of your...
I think if I'm a house and land package type of developer, I've got all my approvals in place. I'm ready to basically get you come and see me today as a young couple.
Yeah.
I'm getting you to sign up and I can start work within a couple of months.
Yeah.
So that works really well. In Tassie, as I said, we don't have the broad acre developers really, some sort of smaller scale. Yeah, the time for you to sit down with a designer and design your own home, get it through council, and then line up a builder. Well, you've got to have a builder by the 31st of December to sign the contract. And I think at this stage, they're talking about 3 months. I think you've got to make substantial commencement work on the build. I just think that will limit a lot of people in practical terms.
Yeah. I think that especially here, it seems really attractive.
Yeah.
But the reality of getting that done and dusted by the end of the year in terms of contracts is pretty
I think
small window.
Kind of limited.
Yeah.
So it will help some people.
Yeah.
But I think it'll be limited application here, just gut feel. The other one was, and the federal government announced at the same time, it might have been 25 for home renos, but I think it was a minimum of 150k spend.
150k, yeah.
I was chatting to my sister-in-law the other week, and she said one of the popular radio stations had calling the whole day of who's going to take that up, and they had 2 or 3 people ring up from Melbourne. The criteria for that is so narrow in my view that I just don't know many people are going to take that up.
Yeah.
But I suppose it does send a signal of confidence and gets people talking about what they want to do. And everyone goes, well, it kind of justify spending 150k on my house.
Yeah. And
the thing, you've got to justify spending 150k on your house and not over-capitalising it. So we're talking about, a $400,000 house, if you're 150 on it, it's 550. Is that, would the market pay 550 for that? So you've got to weigh that up. And then you still got to borrow the money, presuming you don't have 150k sitting in your bank account. So you still got to go through that process and convince a bank what you're doing is adding value to your property. So it's a fairly narrow application.
Yeah, no, I agree. So I think it's a really interesting period. I think the other critical time is at the end of what happens in September.
Yeah.
How does that affect things? Does the government continue on some of these further stimulus packages? I'd say what your thought around the government's ability to impact these environments. They'll probably get to get to a litmus test in December, and we might hear potentially a variation to that announcement where they've extended things over a period of time.
So the things I can see, what do we know? The government is saying 3rd week of July they'll announce some potential changes to the JobKeeper program. And so there'll be winners and losers of that. I think they showed their hand with the childcare industry where they've taken it away and replaced it with the industry approach. They may do that with some industries or might just let everyone, all businesses sit the test again, but they still suffering turnover drop or the business is back to normal. And then we hit and miss. So we'll have those changes potentially. Then end of September is sort of you've got the end at this stage of JobKeeper. You've got the end of a lot of bank holidays on loan repayments. You've got the end of, in business terms, litigation for insolvent trading. You've got the end of, at this stage, the doubling of the job seeker allowance. So I think the government are going to try to massage some of that so that it just doesn't, there's a full stop, that they might go early on some things, for a bit of funding to go, extend JobKeeper for hospitality and tourism as an example, just to soften the load. I sort of just watching some of the press, and let's say the airline industry, where Qantas has announced 6,000 job cuts and Virgin's now been sold, and what's their workforce, 10,000 something. They're going to be job cuts. You just you know it. So you've got a couple, who might have worked for Virgin and Qantas, something like that, fairly wealthy, inverted commas, above the average. All of a sudden, their income's zero come post September. Might have a nice house in Sydney with an investment property. They're going to have to make some decisions. So there's going to be a percentage out of those stats that will have to make a decision because they just can't afford either the house they're in or have a rental property. They might need to downgrade and make those decisions. So they're going to stimulate some market activity and crystallise some of the downturn in property prices. So I don't see that widespread though. I see there'll be pockets of either some suburbs, some types of people will be affected more than most, but the vast majority you can just sort of ride it out.
Yeah.
That's what I'm seeing at the moment or feeling.
It's a bit unknown, bit of riding out. Things affected by, obviously, you discussed the supply and demand and how that affects with migration and populations, and we both know that population drives property prices in Tassie's, in Australia as well. Viewpoint on fluctuation of pricing. Do you think prices will effectively fall?
Yeah, so if you're looking purely investment properties, then rents will decrease because just that's the basic supply and demand. And I'm talking about macro. I mean, you're still going to get, individual properties that might go up and down and stuff like that. We're talking about at a macro level. So you're going to get less yield. So from a property investment perspective, people are going to start debating, like Melbourne, I think 3 or 4% is your rental yield. That drops back to 2%. You're going to go, well, why am I bothering if there's no forecast for capital growth? So a bit of that decision making where people might be a bit ruthless, but we're still living in a very low interest rate environment. I saw the other day, I think, likely Bank of Us now offering your honeymoon 1.99% interest rate on home loans, and you go, wow, 102% in the marketplace. It's just like such a low interest rate environment. Then the level of and the forecasters go, the level of household debt is quite high compared to 2 decades ago. Because the interest rates are so low, I think the percentage of household income spent on mortgage repayments is still around hovering about the low 30% mark, which is, not stressed. Some individuals will be stressed because of that example with the airline one I just gave, they're going to be stressed. But overall, there's not going to be the level of stress. So I don't see a cliff. So softening is the word in some of the Melbourne main markets of Melbourne and Sydney. But I don't see us falling off a cliff. Is my personal opinion.
With property, and got a lot of self-funded retirees might have a super fund, might have a property relying on income, and you might have other structures where you have property housed in that. Obviously, they're going into a bit of unknown with obviously their rental returns and income yields are potentially going to decrease. How do you think that will play out?
So there'll be some people affected where they are relying on rent. So we've seen that. So with commercial rents, through COVID, where a lot of rents were waived and deferred, people were sort of upset, and rightly so. But at the end of the day, they've probably got enough reserves to ride out the storm. In commercial property land, I see that there may be some investments that you might be better to really look at whether you want to stay in that space. So where there may be long-term structural changes would be in retail space and office space, where gut feel, office space, large scale people movement in Melbourne, where they all go into the docklands, 100 people's go into a lift as well, and go up and down all day in close contact. Next couple of years, people are going to go, it just doesn't feel right. So work from home, lease comes up, they go, I don't need 500 square metres, I need 200 square metres. So I see a really strong softening in some of the major markets. And the same for retail. So, your Westfields, owned by Centre, listed company, their price is way down. I'm looking at their share price going, that's pretty flat. I just don't have enough confidence. I don't understand the retail market space well enough. And you just hear too much noise currently that people are going to go, I might not need that full space, or I might close that store and go online, or mix and match. So once again, supply and demand, I think there's going to be less demand for certain types of retail space going forward. So still for retirees, if they've got exposure to that sort of space, I think you really need to put that through a hard-nosed approach. if you're, and the same principles apply for an investor, self-funded retiree owning some rental properties. I'm hearing overall, most people are still getting their rental returns thereabouts. You probably just got to put the ruler through. If your strategy is purely yield or rental return, then it's probably still in the same spot. But if your strategy was a lower yield and you're aiming for capital return, you may not get the capital return in the short to medium term that you're looking for. So what's that mean? If you need to sell a property to fund your pension payment, then you might take a bit of a hit. So it's a matter of then weighing up, do you need the full pension for the next couple of years versus holding out and seeing where the market heads, or do you definitely need that and you might need to cash in your chips on the property at this point in time?
Yeah, so yeah, I agree. I think it's coming up to some decision making. Liquidity is a big issue. Having lumpy assets. Sometimes a rethink on how you hold assets will be thoughtful coming up.
Well, that's sort of another topic almost about. I love investing in property because it's touch and feel. I can sort of supply and demand at a local level, where you say, Norwood versus Invermay versus Riverside versus Kings Meadows, where you can sort of see where things might be going in terms of schools and access to hospitals, all that sort of stuff. So I love that sort of side of things, but they are very lumpy assets compared to if I owned, I don't know, $50,000 worth of shares in a retail shopping centre investment trust, then I could sell it down by half and fund my living expenses through retirement. Whereas, $500,000 house, it's all or nothing. You can't sort of sell out a share of it. So, yeah.
I thought I might go on to broadly around the tax structures and tax considerations.
Yeah,
I suppose give you your points on that.
Yeah, so quickly we'll just touch upon structures. So we're looking at the legal title owner on structures. So they're really starting with the really basic. It's in people's personal names, either as a couple or as individuals. Nice and simple. You get capital gains tax exemption from your main residence. So you hold it, you make a profit. If it's been your house, you don't pay any capital gains tax. So it's really nice and simple. If you're looking for an investment property, it's still a legitimate option to have it in personal names. People often look at, it's negatively geared. So if you are at a high marginal tax rate, that's true. If you are negatively geared, I often look at negatively geared and go, well, why would you invest in something that loses money? So I still like having a positive return as well as potential for capital growth. That's just my personal preference. Other people go, no, I'm going to buy an apartment. I know I'm going to some money, but it's going to double over the next 5 years in capital price, and so I'll wear that and get the tax deduction for it. So, so personal names will work in that space, and I'll come back to deductions because that's sort of part of that discussion. Then you have, if you're a more active investor and you want a portfolio of direct assets, then you might have a family trust, in other words, discretionary or property trust, and you hold those assets in trust, and then you buy, basically the hold strategy, where you're just buying it and you're holding it and then getting wealth that way. So the rule of thumb, because the other option is a private company, a Pty Ltd, the rule of thumb is I don't often recommend to buy in companies, because companies are pretty poor tax-wise when you've got a capital appreciating asset. Fantastic vehicles for operating a business, but if you've got, $200,000 house and it's worth $400,000 in 3 years' time, you sell and make a $200,000 profit. Tax on companies is a flat rate of 27.5% currently, or changes to 26%, I think, in FY21. So it's just a flat rate, and you don't get any capital gains discounts. So they're poor vehicles normally. The only exception I do see is where you're what they call flipping houses. So it's, you buy the house, spend 50 grand on a reno, change it up, and you flip it out within a short time frame and make your profit from the work you're doing and renovation, not necessarily the market rising. So private companies there. So tax considerations to think of. So if you're earning an income, it is assessable income. It's assessable income on the rent less your deductions. So you've got your rent, and typically your deductions you're going to have, if you use a property manager, that would be a deduction. If you've got the interest on any loans you've taken out for that investment. The important thing to note is the interest, not your loan repayments, because you don't get a tax deduction for the loan repayments because you're paying back money you borrowed from someone else. So the interest are charged. Any holding costs, rates, land tax, water, any repairs you do. There's a lot of tax rulings about repairs versus replacement, so just got to be careful when you come to do any repairs on investment properties. The other one is depreciation benefit. So just going back to our personal names, where you can get a negatively geared property from a tax perspective is a depreciation benefit. And there are depreciation companies, quantity surveyors are, B&T's one spring to mind, and they'll do a depreciation report on that property. And they'll say you can claim 2.5%, say, on this component of the property value, and then the kitchen was renovated, and here's what you can do. The government have clamped down on that probably 2 or 3 years ago, where it used to be you used to be able to claim any residual depreciation from previous owners. Now it's pretty clear you can only claim depreciation on any works that you do, but also you can claim the what they call 40-year capital works deduction for the base cost of that building. So, but it can work if you're on a high marginal tax rate. It's certainly worth doing. It costs about $600 or $700 to get the report done. Most times, if you think it's a newish house post 85, it's worth doing that, getting a depreciation benefit. Capital gains tax is a quick run through. It's actually not. It's a bit of a misnomer. Capital gains is not a separate tax regime. It's you make profits on capital gain and you pay for it through your normal income tax return. That's assumed in personal names, and even for a trust, you have what you call beneficiaries that the profits will go to. So going back to the example, buy something for 200, something for 400, make a capital gain of 200. The government at the moment will give a 50% discount on that, so you only pay tax from the 100. If you're in joint names, it's with that again, so it's assessable income of 50k each in each of your personal names. And as you alluded to, you'll pay tax from whatever your marginal tax rate is. So it gets added. So if you've got a job that's paying you 70 grand, you make a profit of 50, all of a sudden your taxable income's 120,000, you're paying roughly 37% on that capital gain. So it can dilute some of the enthusiasm of making all this profit, but that's a legitimate strategy some people do as well.
Given that property's got capital growth and obviously a yield, what being from your view, what would be a reasonable yield that you should get for the sort of investment?
So I always like, the classic rule of thumb, you get a $300,000 property if you get $300 a week rent from a residential. You don't really get that strong return in the current environment. And so then you go, okay, you lower your yield because your interest rates, maybe 3.5% on investment property now. I still like aiming for that 5% sort of income yield on your property. And especially in Tassie, you now got water rates, and so the water rates through the usage paid by the tenant, but the actual supply to the building is paid by the landlord. So you've got a few other costs. Land tax has gone up recently. So there's a few other costs. So anything less than that, you're sort of struggling a bit. As I said, in Melbourne markets, the people will accept to throw a 3% yield on rent, with the gain being that they're going to get a stronger capital growth, which is true. Tassie's renowned for not getting strong capital growth, but I think you can still get some capital growth, but it's always lumpy. You never get the huge spikes that Sydney, Melbourne and other places get, and they just take off all of a sudden. we just go flat, 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 and all of a sudden it bounces up and then flat, flat again. So it's just got to play the long game. It's very hard, I think, in Tassie to sort of buy property and say, I'm going to sell in 3 years' time and just make market forces give you the capital yield, capital growth I'm after.
Yeah. So it's being a little bit more thoughtful about the environment that it is down here in Tassie.
Yeah, it's a different type of mix between rental yield and capital growth.
I always remember the 1990s, especially in Launceston, property prices
didn't move for nearly a decade.
So it's always that risk.
Yeah. And then I remember we moved to Adelaide in 2001 or something like that, and came back and house price had doubled in 2 years. So, yeah. All right. Summary. So, sorry.
So summary, the effect of a few unknowns at the moment. How that job, the stimuluses for the home building packages will play out.
Yep.
What impact that will have. Also, if prices will fluctuate, rise or fall. And then from my point of view, timing, do you jump in and have a go at trying to cash in on some of these stimulus packages, or do you hold off from a perspective? I think what you alluded to before is that this will affect some people in the market. Some people will right.
Yeah, if I'm looking for my potential first home, I'd be saying to people, you'd be a fool not to have a really strong look at this, because you don't every day you don't get 45 grand potentially put in your lap to do something with.
Plus, potentially the benefits that some of the developers are offering as well.
Yeah, so have a really close look at it and work through if it works for you. But from an investment perspective, you might be a bit more circumspect. And try and ride it out as best you can.
That's all we had today, Mike.
All right, thanks for that. We might just stop the recording and and then stop the recording somewhere. Down one.
That's it.
Yep, just the left where you are.